Missed Groww, India's 2025 IPO cycle and the anatomy of post-listing wealth creation. The Indian equity market in 2025 produced a defining moment for retail investors, not because of a single spectacular listing, but because of a broader structural shift in how capital is being raised and deployed. The IPO of Groww became a psychological anchor of this shift. It was not merely a brokerage going public, it was the visible culmination of a decade-long transformation in Indian household finance, where savings migrated from physical assets and fixed deposits towards market-linked instruments. Growth, listing, and rapid post-IPO appreciation created an emotional fault line in the retail community. Those who participated felt vindicated; those who missed it experienced a sharp sense of regret. Yet, focusing only on Groww obscures the more important truth. 2025 was not a one-stock phenomenon. It was a year in which multiple IPOs across unrelated sectors managed to double investors' wealth through fundamentally different drivers. Grow's success must be first understood in this context. India's brokerage industry has already undergone a generational reset. Low-cost digital platforms displaced legacy brokerages, and user experience became as important as pricing. Groww entered public markets at a time where demat account base was expanding at an unprecedented speed. Powered by smartphone penetration and UPI-led financial plumbing, our decisively demographic skewed decisively towards first-time investors. Company posts listing surge reflect not only just earning expectations but a belief that Groww has become infrastructure rather than a mere intermediary. Even as regulatory pressure intensifies, investors were effectively betting that the platform's scale and embeddedness would allow it to absorb friction better than smaller competitors. However, the fixation on Groww led many investors to overlook the fact that the wealth creation in IPOs rarely followed a single narrative. The same year that Groww dominated headlines, other newly listed firms quietly delivered comparable or superior returns through entirely different economic logic. The most prominent among them was Ather Energy, whose trajectory illustrated how sectorial tailwinds can overpower even a muted listing debut. Ather's IPO was initially overwhelming, offering little to the instant gratification that retail traders often seek. In fact, the stock briefly slipped below its issue price, reinforcing skepticism around the electric vehicle profitability. But markets are forward-looking mechanisms. As execution flows strategy, statement reversed decisively. Arthur's rally was anchored in fundamentals rather than hype. The transition to lithium iron phosphate batteries materially improved cost structures and margins, whose while strong festive demand validated pricing power in the premium electric two-wheel segment. More importantly, investors began to differentiate between EV companies chasing scale recklessly and those prioritizing engineering discipline. Arthur benefited from being perceived as a latter. As operational metrics improved quarter by quarter, the stock repriced sharply upward, eventually delivering a clean doubling from its IPO level. This was not momentum trading, this was delayed recognition. A similar but distinct story unfolded in the industrial segment with Mamata Machineries. Unlike consumer-facing IPO, Mamata Machinery entered the market without mass retail excitement. Its business manufacturing specialized packaging and processing machineries was technical, export-oriented, and high and relatively invisible to the average investor. Yet this invisibility worked in its favor. The IPO was reasonably priced, promoters retained credibility, and the company operated in a niche, benefited from a global demand for automation and efficiency. The stock delivered a spectacular listing pop, followed by a correction and then stabilizing at levels still far above the issue price. What distinguished Mamta was resilience. Even during periods of broader market volatility, the company's order book and margins supported valuation, reinforcing investors' confidence that the gain was not speculative access. If Mamta represented industrial durability, Stallion India Fluorochemicals exemplified the power of niche dominance. Stallion's business model revolved around refrigerant gases, a segment characterized by high entry barriers, regulatory complexity, and limited organized competition. Unlike sector where capital floods in at the first sight of profitability, fluorochemicals demand specialized manufacturing capabilities and compliance expertise that deter casual entrants. Stallion's IPO was priced conservatively, and the company quickly became a textbook case of how scarcity and specialization translate the valuation expansion. As demand visibility improved, competition remained constrained, and the stock steadily climbed, eventually delivering returns comparable to far more glamorous consumer names. Taken together, these four IPO dismantle a common misconception about public listing, that post-IPO wealth creation is either random or purely momentum driven. In reality, each of these companies doubled investors' money through a different pathway. Groww benefited from platform economics and financialisation. Ather rode structural EV adoption paired with operational discipline. Mamta leveraged global industry automation trends. Stallion exploited niche scarcity in chemicals. The unifying factor was not sector or size, but valuation discipline combined with credible execution. The broader market environment also played a crucial role. India's benchmark indices, Nifty and Sensex, oscillated through 2025, reflecting global uncertainty, domestic earnings moderation, and sectorial rotation. In this context, IPO that delivered sustained gains stood out precisely because they outperformed a volatile baseline. Market heatmaps frequently showed a mix of red and green, with the legacy heavyweights dragging while selecting post-IPO names resilient. These divergence enforced a subtle but important lesson for investors. New listing when correctly priced can offer cleaner exposure to growth than more mature incumbents burdened by legacy constraints. Regulation, often cited as headwind, added another layer of differentiation. The Security and Exchange Board of India intensified scrutiny over brokerage prices, derivative exposure, and disclosure norms during this period. While such measures created near-term pressure across the industry, they also served as stress tests. Companies with weaker governance and unsustainable model revenues faltered, while those with robust systems adapted. Grow's ability to retain investor confidence despite regulatory tightening underscored the market's preference for scale, transparency, and over-aggressive monetization. The psychological dimension of this IPO cannot be ignored. Retail investors offer anchor to the most visible success, extrapolate regret from missed participants, and the phrase "missed grow" became shorthand for this phenomenon. Yet the data tells a more nuanced story. Opportunities didn't vanish after one listing, they simply diversified. Investors who broadened their analytical lens beyond headlines names found comparable outcomes in less obvious places. In this sense, 2025 functioned as a corrective year, teaching the market that wealth creation is not rarely monopolized by a single narrative. Looking ahead, the implications are significant. As India's IPO pipeline expands, the lesson of 2025 will shape both issuer behavior and investor expectations. Companies are likely to prioritize listing pricing and post-listing credibility over maximizing issue day optics. Investors in turn, may become more patient, focusing on execution trajectories rather than due performance. The success of Groww, Arthur, Mamta, and Stallion suggests that the next phase of India's capital markets will reward discipline over spectacle. Ultimately, the 2025 IPO cycle should be remembered not for the missed opportunity, but for the proof that it offered that India's markets are maturing. Multiple sectors, multiple business models, multiple paths to value coexisted within a single year. For investors willing to look past the loudest story, the rewards were substantial. The real lessons of missed growth is about is not about regret, is about recognition. Recognition that wealth creation is systematic, repeatable, and available to those who understand where to look and why, as well as who knows when to look at them.